Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me remotely, I have Brian Joyce, who's the managing director on Nasdaq's Market Intelligence Desk, as well as our chief market technician. And assets are highly correlated, Brian, and it's interesting because safe havens are selling off along with equities. What do you make of that?
Good afternoon, Jill. So thanks for having me on. So yeah, absolutely. We are seeing not just equities and other risk assets selling off, commodities, etc., but gold, and now we're seeing over the last week and a half, U.S. Treasuries are doing the same thing. And it's really a need for investors to access liquidity and really that source of funds, because other areas of the portfolio are not doing well, and whether it be margin calls or just trying to offset losses, having to sell winners or instruments or assets that there's an expectation that the future is going to do well in the short term. You may see some volatility and some declining asset prices before that positive expectation plays out.
All right, let's take a look at our first chart here. This is S&P 500 60-minute period. Tell us what you're looking at here.
Okay, so yeah, this is a zoomed in look at the decline that's been happening over the last 4 weeks. Whether off the high back on February 19th, we had a 16% decline, 538 points down. That's what we call a wave A, and had a 10% rally of about 281 points, which was a near 50% Fibonacci retracement. And so now that we've rolled over the last 2 weeks, this decline has measured 27% to the downside, about 856 points. As you can see, that's about 161.8% extension of that initial 538-point decline. So initially, my base expectation was for the wave A and wave C down to be nearly equal in size. That would have taken us to the 2600 level, where you could see that first white horizontal line with this 100% description there. Once we broke down below there, the next projection was that 161.8% Fibonacci level, and that's pretty much where we stalled yesterday. And as you can see, we're up higher today. Now, it's still unclear whether or not that will be the end of this third wave down, but at the moment, it's holding, and that's where I think if you're looking to jump in as they say, short-term investor and looking for a risk level to measure your risk at, or price level to measure risk at, that's where I would be looking towards.
All right, moving along to our second chart here, the U.S. dollar index looking to make 18-year highs. It's kind of surprising considering all the monetary actions that the Fed has been taking.
Right, and it's absolutely, you would think that given the $1.5 trillion that the Fed has injected, the $700 billion in QE with the $500 billion in purchases of treasuries and the $200 billion of expected purchases of MBS, and other measures outside of that, you would think it would make the dollar weaker. But the part of the problem here, I think that's going on, that the Fed is trying to fight, is this demand for U.S. dollars, the lack of dollar liquidity, and you're seeing it up here in the chart. So this is a chart of the U.S. dollar, the basket of the DXY, the dollar index, the DXY. It's heavily weighted to the euro, I think about 58, 59% weighting, and then the yen, I think, brings that to about 75, 80%. But as you can see, it's on the verge of breaking out above its 2016 highs, which, if it does, would then probably reach its highest level in roughly 18 years. So certainly it looks to be that dollar strength is here to stay, and that's not necessarily a good thing for the global economy, particularly emerging markets.
Yeah, and if we take a look at our third chart here, the JP Morgan Asian Dollar Index, the ADXY, that's certainly telling a very different story.
Right. Well, yeah. So this is a basket of Asian currencies against the dollar. The way this tracking basket is linked is that when it's moving lower, it actually is showing dollar strength and weakness across Asian currency, particularly the Chinese yuan. But as you can see, this just broke down below its prior lows of 2008 and 2016, 17. So those were periods where we saw extreme risk off. We're clearly in that same type of situation now, and we're making new lows. So Asian currencies are making new lows versus the dollar. Said in the inverse, dollar is making new highs versus this basket of Asian currencies, which is again reflecting that strong, extreme dollar demand we're seeing. and it looks like it's going to continue. So I would expect if the Fed wants that to reverse, they're going to have to do more. And we actually did see that today. They initially had 5 existing swap lines to other countries, and they've expanded that to 9 additional countries that today they opened their swap lines to. So I suspect part of that is due to the fact of how strong we're seeing the US dollar.
All right, moving along to our fourth chart here. We talk about the 10-year Treasury all the time. I never thought that we'd ever see a move as extreme as we have seen over the past few weeks. It's not typical for yields to move like that.
Right. And this goes back to what we spoke about earlier. There was an extreme demand when we first had the call. There was an extreme demand for treasuries in January and in February. That broke down below that 130, 140 level. Those were the lows made back in 2012, back in 2016, and more recently in the summer of 2019. We knifed right through it, and there was no volatility. It was just straight down from there. There was very little, as they say, in a bull market, instruments, take the steps up, and and bear markets, the ladder down. As you can see, this was straight down, or I should say the elevator down. And this was just straight down. We bottomed at 31 basis points last week, but we have since rebounded, and this is what's noteworthy. We have since rebounded to a high today and yesterday of about 1.27, 1.28%. And this goes to that topic we were mentioning earlier about it's not just the risk assets being sold off. Right now, over the last week and a half, we're seeing safe havens like treasuries and like gold selling off as well. And there is some historical precedent to that, as we can see on the next chart that I think that you have, which shows 2008.
We can see in our final chart here, it's not typical to see asset classes trading in tandem with each other.
Correct. Typically, when you have a strong move to the downside in the equity asset class, like an index such as the S&P 500, you see a move into safe havens, which drives treasury prices higher and treasury yields lower. We're at the point now where there's such an extreme need for funds, that source of funds, that we're seeing everything being sold off, equities and treasuries and gold and Bitcoin, despite the fact that we are having these massive injections by the Fed and the quantitative easing. I think we're up to QE5 right now. And so if we go back into the middle of September 2008, right after Lehman Brothers went down, this chart we're looking at here in the top panel in the yellow line is the S&P 500. In the lower panel is the yield of the U.S. 10-year Treasury bond. And you can see from that 4-week period, from mid-September to mid-October 2008, right after Lehman Brothers went down, the S&P declined about 30%, but the yield on the Treasury went up from about 3.25% to about 4.25%. So not typically what you see, but it's a reflection and shows that there is historical precedence for what's going on right now, whereas, again, equities and bond prices are selling off at the same time.
All right, Brian, great to have you with us. Thanks so much for joining. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.